Hello everyone, and welcome back to Gold Rush Reporter, your go-to place for all things gold and silver. Today, we're diving into a story that's going to shake up how you think about the gold market. If you've been watching the price of gold lately, you know it's no joke. $4,500 an ounce is not just a number, it's a statement. But what's really happening behind the scenes? Let's break it down. We're talking about a market that isn't done growing, even though gold is already incredibly expensive. There's a huge structural deficit, meaning there isn't enough gold coming to market to meet demand. For decades, the London Bullion Market Association, or LBMA, has been controlling prices in tiny, almost invisible ways. And here's the thing. If the only trading hours for gold were London-based, the price of an ounce would literally be just a few dollars. That's right. We're talking about a price suppression scheme that's been running for decades, hiding in plain sight. When London is closed, gold prices skyrocket. If you look at those cumulative gains outside of London trading hours, gold would be approaching $40,000 an ounce. That's not a typo. And it's not just gold. Silver follows the same pattern, showing us the manipulation is widespread. The structural deficit isn't a theory, it's evidence backed by years of data. Mining can't keep up with demand, and what's coming to market is nowhere near enough to satisfy global appetite. But there's more. While the LBMA is suppressing prices, other major forces are at work behind the scenes. The US government has reportedly been quietly accumulating gold since December 2024. Imports into the US spiked in a way that's highly unusual, suggesting the possibility of secret stockpiling. If true, this could have massive implications for global supply and market stability. And it doesn't stop there. There's also talk of new strategies that resemble historical currency adjustments, aiming to influence the value of the dollar relative to other currencies. All of this means one thing. If you're a gold or silver investor, the next few months and years are going to be wild. Price manipulation, secret accumulation, and global strategy all play into a market that's far from predictable. The key takeaway here is that the story isn't about the price today. It's about the forces shaping the market tomorrow. Stay with us as we dig deeper into these 5 major predictions and show you what's really happening in the gold market and why it matters to your stack. Let's get into the first prediction, a major corruption scandal at the LBMA. It might sound far-fetched, but the signs have been there for decades. Price suppression has been happening in tiny increments, day after day, for over 50 years. The AM and PM fixes in London effectively control the gold price for the world, ignoring overnight trading elsewhere. If gold only traded during London hours, the price would be virtually nothing compared to what we see now. Meanwhile, when London is closed, gold surges to astronomical levels. This manipulation isn't just theoretical, it's documented in charts showing black and blue lines that contrast the LBMA-controlled price versus the actual market trajectory. Silver follows the same pattern, confirming that both markets are subject to similar schemes. Even the COMEX operates as a fractional reserve system, with far more paper ounces than physical metal, and when banks are caught manipulating, people do go to jail. Yet mainstream attention remains minimal. Prediction 2 is about the US government quietly accumulating gold since December 2024. If you examine net imports, subtracting exports from total imports, you see a massive spike into the United States. Historically, the US is a net exporter of gold, so this reversal is unusual. Some of this gold ended up in COMEX vaults, preventing a force majeure event during COVID and keeping prices from exploding. But excess gold that didn't reach COMEX could have been quietly accumulated by the government. It's speculative but plausible, especially considering how other nations, like China, have understated their reserves. If the US is quietly stockpiling gold, it would affect global supply, reinforcing the market's structural deficit and creating an environment ripe for price spikes. The third prediction involves a soft devaluation strategy similar to a decentralized Plaza Accord. Historically, the Plaza Accord intentionally devalued the US dollar to stabilize trade. Today, the situation is different. The dollar isn't doubling against foreign currencies, and other countries aren't incentivized to cooperate. If the US attempts a similar strategy, it will likely be unilateral, inflating the money supply domestically. This is where gold and silver come in. They become natural hedges against currency dilution. Printing more dollars could ignite a race to the bottom globally, where countries try to maintain export competitiveness by devaluing their own currencies. The result? Inflation, volatility, and continued upward pressure on precious metals. Prediction 4 is that the US will revalue its gold holdings to support fiscal objectives. On paper, this is a balance sheet trick. Increase the statutory value of gold, which inflates the asset side of the government's accounts, allowing the Treasury to theoretically spend the difference. If done at current market prices, this could create a $1 trillion injection, but it wouldn't even cover the federal deficit, which is in the multiple trillions. This isn't actual wealth creation. It's a disguised transfer of purchasing power from the public to the government, and it introduces massive volatility. The revaluation alone wouldn't fix the debt problem. It would just shift numbers on a ledger while inflating the currency. Any attempt to pay down debt this way would disrupt markets, and the resulting roller coaster in currency and gold prices would blindside most investors. This strategy underscores why relying on fiat accounting gimmicks instead of sound money is inherently unstable. Prediction 5 is that the US will use gold to retire debt and stabilize trade relationships. This isn't hedging in the traditional sense, it's leveraging. Gold would act as a fiscal tool to manage obligations and influence international trade. In practice, this could involve unwinding gold leases, reallocating reserves, or manipulating accounting values to cover shortfalls. The effect on markets could be profound. Sudden liquidity injections, temporary stabilization, and abrupt inflation spikes. While it sounds controlled on paper, in reality, it's unpredictable. Even the slightest miscalculation could amplify market disruptions rather than smooth them out. These strategies are complex, opaque, and largely inaccessible to retail investors, which is why precious metals often outperform fiat during these periods. The combination of these 5 factors, the LBMA manipulation, quiet government accumulation, soft devaluation attempts, gold revaluation, and leveraging of gold for fiscal objectives, creates a unique environment for precious metals. Gold and silver aren't just commodities here. They're insurance against systemic manipulation and policy experimentation. Investors who understand these dynamics and act strategically are positioned to benefit, while those who ignore them risk exposure to rapid price swings, currency devaluation, and financial instability. The market isn't random. It's being influenced by deliberate structural factors that make timing, allocation, and understanding supply-demand dynamics critical for anyone holding or acquiring precious metals today. Looking ahead, the key takeaway is that this bull market in gold and silver isn't over. The structural deficits in production, manipulation by major exchanges like the LBMA, and strategic moves by governments all point to continued upside potential. Silver, in particular, is underpriced relative to gold, making it a high leverage play for investors who understand the market dynamics. As more of the world shifts to industrial demand, like solar panels and electronics, the scarcity of physical silver will only intensify, potentially driving prices much higher than most forecasts predict. At the same time, gold remains the ultimate hedge. With governments quietly accumulating reserves, experimenting with revaluations, and leveraging holdings for fiscal objectives, the value of physical gold is being insulated against systemic risks. For retail investors, understanding the difference between paper markets and actual physical metal is critical. The COMEX and LBMA may continue to suppress prices temporarily, but the structural realities of supply and demand, coupled with policy interventions, point to a long-term upward trajectory. Timing, patience, and strategic accumulation are essential to maximize gains in this environment. Finally, for those who are serious about stacking, the top-tier holders, the 1% and 0.1% stackers, aren't just speculating. They're positioning themselves for systemic changes. Whether it's through consistent accumulation, focusing on silver for leverage, or using gold as a hedge against fiscal experiments, these investors understand the broader economic currents that most market participants overlook. This is a unique moment in history where knowledge, discipline, and access to physical metals can translate into extraordinary financial advantage. To wrap things up, the lessons are clear. Gold and silver remain critical assets in uncertain times. Understanding market manipulation, structural deficits, and government strategies gives you an edge most people simply don't have. Whether you're stacking for wealth preservation or growth, knowing the difference between physical metals and paper markets, and recognizing when strategic accumulation is taking place, will keep you ahead of the curve. Remember, silver's scarcity and industrial demand, combined with gold's role as a hedge, create opportunities that can't be ignored. Those who act now, with discipline and strategy, will be positioned to benefit when market realities eventually assert themselves and prices reflect true value. Thank you for joining us today on the Gold Silver Show. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell so you won't miss our next deep dive into precious metals, market strategies, and investment insights. We'll see you in the next video. Stay sharp, stay informed, and keep stacking those silver dragons.